Okay, let's dive into the world of bonds. In simple terms, a bond is basically an IOU. It's a certificate that proves a borrower owes a specific amount of money to a lender. To pay it back, the borrower agrees to make interest payments and repay the original sum on specific dates. There are tons of different types of bonds out there, and they can be issued by a few different entities. You've got corporate bonds, which are issued by private companies, and sovereign bonds, also called govies, which are issued by local or national governments. Even international organizations like the World Bank can issue bonds. Now, when we talk about bonds, a big deal is the risk that the borrower might not be able to pay back the money. This is called default. To help investors understand this risk, there are things called ratings. Ratings are like a measure of how likely it is that the borrower will be able to repay. Independent agencies like Moody's, Standard & Poor's, and Fitch give these ratings. They look at things like the borrower's financial health and how much debt they have. Basically, the higher the rating, the safer the bond is considered. Another way to measure the potential risk of default is through something called a credit default swap, or CDS. Think of it like an insurance policy against the borrower defaulting. The higher the price of this insurance, the riskier the bond is perceived to be. Bonds can also differ in terms of the currency they're issued in. Issuers might choose to raise debt in a currency other than their own, which introduces currency risk, as the return on the bond will depend on how exchange rates fluctuate. However, this can be useful for things like diversifying risk or offsetting currency risks from other business activities. Another key characteristic of a bond is its maturity. This is the date when the bond expires and the principal is repaid. Most bonds pay back the principal at the end, but some might pay it back gradually over time, similar to a mortgage. Maturities can vary wildly, from just a few months to even a century. Generally, longer maturities mean higher risk. Many bonds also make periodic interest payments called coupons. These are usually a percentage of the bond's par value, which is the face value of the bond. Some bonds, called zero-coupon bonds, don't pay coupons at all. Instead, they're sold at a discount, and the return comes from the difference between the purchase price and the par value paid at maturity. Coupon rates can be fixed or they can float, meaning they change over time based on a benchmark like an interest rate. There are also bonds with special features called options. For example, a callable bond gives the issuer the right to redeem the bond before its maturity date. On the flip side, a putable bond gives the investor that right. Then you have convertible bonds, which can be exchanged for a specific number of shares of the company's stock. Finally, there's seniority, which refers to who gets paid first if the issuer defaults. Debt generally has priority over equity, and even within debt, there can be different levels of seniority. Secured bonds have a guarantee, meaning the creditor has a claim on specific assets if the issuer defaults, while unsecured bonds don't have this protection. In recent years, we've also seen the rise of green and social bonds. Green bonds fund projects with a positive environmental impact, while social bonds fund projects with a positive social impact. There are even sustainability-linked bonds, where the coupon payments are tied to achieving certain sustainability targets. Okay, building on what we've learned about bonds, let's talk about mini-bonds, volatility, and duration. So, to help smaller and medium-sized enterprises, SMEs, get funding more easily, especially when credit is tight, some EU countries came up with new rules for something called mini-bonds. Basically, these are bonds issued by smaller companies to raise capital. The Italian exchange even created a special trading platform for these mini-bonds, called Euronext Access Milan, which has lower fees for the companies that issue them. Now, a bunch of Italian SMEs, even smaller limited liability companies, have been able to raise money by issuing these mini-bonds. You can even find some of them on crowdfunding platforms. And as part of this mini-bond category, there are also things called commercial papers, which are used for financing working capital. Now, let's switch gears and talk about volatility and duration. In the bond world, duration is kind of like the time barycenter of a bond. It's a weighted average of when you get your coupon payments and the principal back. For a zero-coupon bond, Duration is equal to its maturity, and this duration is linked to volatility, which is how much a bond's price changes when interest rates change. Bond prices and interest rates move in opposite directions, so they have a negative relationship. So, if interest rates go up, bond prices tend to go down, and vice versa. The higher the duration, the more volatile the bond's price will be when interest rates shift. Okay, so you're thinking about investing in bonds and want to know how to figure out their value? No problem. Let's break it down. The way you evaluate a bond depends a bit on whether it's a zero-coupon bond or a coupon-paying bond. Let's start with zero-coupon bonds. These are the simpler ones. To figure out the price of a zero-coupon bond, you basically discount its face value back to the present. The formula looks like this. Price equals face value divided by 1 plus discount rate to the power of maturity, where the discount rate includes the risk-free rate and a spread to account for the bond's risk. With coupon-paying bonds, it's a little more involved. You need to consider the present value of all the future coupon payments and the present value of the face value you'll get back at maturity. So, the price of a coupon-paying bond is the sum of these present values. Bond valuation can get a little tricky because you have to consider a few different prices. There's the dirty price, which includes the present value of all the coupons, and the clean price, which doesn't include accrued interest. This accrued interest is basically the part of the next coupon payment that has already been earned. Traders usually use clean prices to compare different bonds. Also, when you're dealing with riskier or less liquid bonds, you have to adjust the discount rate to reflect that higher risk or lower liquidity. This usually means adding a spread to the discount rate, which will lower the bond's price. To wrap it all up, bonds are a really important part of the financial world. They're essentially loans that can be traded, and they come in a huge variety of shapes and sizes. We've walked through the basics, from what makes a bond, to the different types you might encounter, and even how to figure out what they might be worth. Understanding bonds is key, whether you're thinking about investing, running a business, or just trying to get a handle on how the economy works. They play a big role in how money moves around and how different players in the economy interact. Of course, there's always more to learn, but hopefully, this has given you a solid foundation to start with.